America. My name's Max Drew, and I'm a CPA based out of Sacramento, California, coming to our nationwide audience here from the Financial Client Podcast. Thank you for allowing me to introduce myself. I hold my licenses within the state of California and may be licensed in select other states depending on locality. Please note that this is not specific financial advice for you. This is just general ideas talking about the financial market as we know it based on my experience and my insights for the last 10 years as CPA with his own practice working with the Dave Ramsey program. If you don't know who Dave Ramsey is, he's the national voice in the finance world, so I invite you to check him out. Although my program that I'm talking about may or may not align specifically with Dave Ramsey's programs. So thank you for joining me today. And today I want to talk about 10 things smart people know about the market but are secrets to people who don't know about investing. The first thing that we're going to look at today is investment a gamble. Many of you may be on the sidelines and may not have yet begun investing in the stock market, your personal retirement plan, your 401k at work, or other things for various reasons because you may look at the stock market as a gamble. And I want to talk about some of the different risks that there are in the market and why we might think that investing in the market's a gamble and what we can do to mitigate those risks. So the first risk I'm going to talk about is what I call selection risk. Selection risk means that we go out there and we put our money in the stock market and we decide that we're going to choose a stock and we don't know what to choose. Maybe we hear from a friend or a radio podcast or a financial advisor, oh my gosh, this next stock X, Y, and Z is going to be the next biggest thing. As my dad would have said in the 1920s, it's the next best thing compared to sliced bread, They used like those kind of old nerdy expressions back then. But what might have happened is he might have bought a stock. It might have been a high value stock. It might have been a low value stock. It might have been a penny stock. Well, let's not worry about the terminology right now. But anyway, people would choose a stock and they would hope that that stock would perform well in the long run and that their investment would increase. Now, my father, who was born in the 1920s, he actually had some bad experiences with the stock market and he did most of his investments in real estate. So that's another story. But the reason why he had a bad experience was he chose stocks that didn't perform well and he lost a significant amount of money. So one thing that can make investment seem like gambling is selection risk. Now I'm going to talk about what smart people have learned in order to avoid selection risk. And one of the things that they have learned is not to put all of your money in one stock. Now, we're going to go back probably about 20, maybe even close to 30 years in history. People have learned to move away from single stock picks when they're trying to choose their portfolios, and many people prefer to invest in mutual funds. It doesn't select just one stock, but often includes maybe 30 different stocks. People went from the first generation of investment in the stock market, where they would select one stock, hold on to it, hope it performed well. And if it did well, they might do good. If it did nothing, they might feel, I could have kept the money in the bank. And if it did poorly, they might regret it. So we're going to think about buying a mutual fund because a mutual fund is essentially one selection of investment, but within that selection, there could be 20 or 30 stocks held in there. So the idea was that one stock may perform well. It could perform poorly. You could lose all your money. You might gain quite a bit of money. Now, with the mutual fund, the idea is that with these 30 stocks, it's unlikely that all 30 of those stocks would fail and that you're going to likely perform a little bit closer to what the overall market might perform as you have chosen that mutual fund. So the next generation, generation 2, which I'll call it, this is my own terminology, the mutual fund. Now, there are some problems with the mutual fund. One of the pros is that we have eliminated selection risk, but for the privilege of having a mutual fund that holds those 30 or so stocks, we now have been exposed to a few other things. And one of the things is a fee drag. I'm not necessarily against fees. I think some people get a little bit overly concerned about fees. I look at the performance minus the fees to see the net performance to see if it makes sense. But all things being equal, sometimes mutual funds have been known to have high fees. And if they're performing just average compared to some other investment options, the fee drag might make that perform a little bit less effectively than if we had another option where we could have the same performance with less fees. So we'll talk about that a little bit later. So one problem with mutual funds could be that there's a fee drag. The second problem about a mutual fund is many times mutual fund may be priced daily and it's not going to be as responsive to the market. It may not be as easy to sell as a single stock. In fact, some mutual funds are highly traded, while other mutual funds are infrequently traded. So if you happen to be in a smaller offering mutual fund that not many people know about, somebody might not be familiar with the mutual fund, and they might not be seeking the mutual fund, and it might take longer to trade, and you might get less price that you would desire as soon as you'd like to get that price. So there could be a liquidity aspect of it. It could be less liquid than a single stock, for example, and there could be higher fees for having to invest in that mutual fund. So fee drag and liquidity could be two issues that you might be giving up as far as the downside, but on the positive side, you have a well-diversified, hopefully a well-diversified selection. Now, some mutual funds may invest in a certain sector of the economy, and they also may be widespread and diverse. So just because it's a mutual fund doesn't necessarily mean that you're widely diversified. It might take a little bit of knowledge, and you might want to consult with the licensed financial advisor to see if that particular mutual fund is diversified enough. You can also maybe think about doing some research yourself using sites like NerdWallet or Investopedia, things like that. Though those tend to be full of advertisements, I am kind of a fan of finding a financial advisor that you can trust to help guide you. The next thing that we're going to look at is what I call the next generation of investments, stock investments. So generation number one was, somebody trying to sell you, as they say, the next best thing compared to sliced bread, as my dad would have said back in the 1920s when he was born, where you have all the selection risk and you may or may not do well. The second one was mutual funds, where we got rid of some of that selection risk, but then there are other risks as far as it might take more time to actually understand it. There could be fees involved, and there could be less liquidity. There could be a timing liquidity drag where it might take you a couple of days to get the price you want. And maybe the price you're seeking, if it's not a highly traded mutual fund, could be less than you would expect compared to the underlying investments. The next generation of investing is what is known as the ETF, and that's a exchange traded fund. One of the big popular ones nowadays is index funds. And if you've been following investment advice at all, you might have heard about index funds and exchange traded funds. A simple way to understand exchange traded funds, now this is my own language, I liken it to be a high performing mutual fund in a way. And high performing, I mean it tends to have less fees, so it's more fee efficient typically, and also more understandable because oftentimes it's following an index that's known to us, such as the S&P 500 or the Dow Jones, et cetera, and also higher liquidity, because one of the things that makes it more liquid is people understand what the underlying investments might be or what the proposal is for the index. So they tend to be a little bit more frequently traded and better understood if they're following one of the major indexes. Now, that's not to say that there couldn't be an exchange traded fund that was less highly traded or maybe people knew less about it. But in general, we can say exchange traded funds are like a mutual fund and almost like a mutual fund on steroids, perhaps. And when I say on steroids, they perform a little bit stronger than the other mutual funds that we traditionally think about. A couple of things you might want to think about What's the downside of an exchange traded fund or an ETF that follows an index? For us as Americans, might be a downside. Well, one downside is we might have less participation in the voting and management of the company. A lot of people don't realize it, but when you buy stocks, you also will have the option most of the time to vote or participate in the shareholder meetings and elections for the company. And oftentimes, when you buy an exchange traded fund, which could be investing in, perhaps 30 companies or 500 companies, or however many companies that exchange traded funds going to invest in, oftentimes people will decide to give up their rights to vote, and they'll allow the fund manager to vote by proxy on their behalf. That ends up being a situation where some of these big companies like Vanguard or BlackRock will end up having a large concentration of votes, where they'll be able to, the investment fund managers, they'll actually become the majority votes, or the most weightiest votes in these different publicly traded companies. As investors, we might like the efficiency of the exchange traded funds. We might like the profits from them. But if you're feeling like you want to participate in the say of how the companies run and the management of the company, you might want to choose to not give up your voting rights. But it's one thing as an investor to be aware of, that if you want to participate in the voting rights of the company, you might want to take a look at, when you elect to get that exchange traded fund, how your voting rights are being elected, whether it's giving it to the fund manager to make that decision, or if you'd like to make that vote yourself. Another major risk that we're looking at, especially when we're maybe dealing with an ETF, is when we decide to buy in and purchase the stock, could be timing risk. So timing risk could mean that you happen to be buying at a time when the market's just hit its peak. The markets have hit their peaks during different times. And one time when the market hit a peak was during the dot-com boom. I believe that was around 2001. And we'd had a decade that was down. For almost a decade, the market was relatively flat. So I've heard it termed as the lost decade. So that could be a way that you could invest in stocks. You could be diversified. You could have your fees low, but you might find for a substantial amount of time, because you happen to buy at the top of the market, that you could lose seeing your investment increase over that period of time just because you got in at the wrong time. Recently, the market has not been flat. In fact, we've had historically aggressive markets and highs in the market. Another time that we had a big downturn was in the 2008 housing market. Of course, you can go back into the 1980s, I believe, and they had the junk bond markets and things like that. So there's always different events that are precipitating ups and downs in the market. In 2008, you might remember, it was the mortgage lending crisis, where people had been getting all kinds of loans for houses, but they didn't necessarily have the ability to pay. They didn't start addressing the predicted cash flow of the borrowers. Now, 2008, we kind of rebounded within a short period of time, within 5 years. If you were following the indexes, you're generally going to be up with the markets. But there came along another time, that in more recent history, where the market kind of tanked, and that was during the pandemic. The markets dropped suddenly in 2020. The markets came back within a 1 year period of time. And then in 2022, we had a down market. And recently, we've had some recent volatility due to the tariffs. So those are all different timing considerations of the market. So how can we get around those types of things? How can we get around the market risk and the timing risk? Well, those are bigger questions, but there are a few products that might help you to get around those risks also. One type of risk that people go to that might not pay oftentimes as much as stocks, or appreciate as much as stocks, are notes. but people might choose to go for something that they feel is a more certain payoff, where they're going to loan some money and they're going to get paid at a certain interest rate for that. Now, I do want to talk about another new generation of things we're seeing on the market. That's something called an exchange traded note. These are debt instruments like a bond. They'll have a QSIP. So instead of a ticker symbol like a stock, they'll actually have a QSIP. Now, we've seen a couple of different forms of them, which are very interesting. And this is, you have to look at each one by itself. Each one is a unique offering. But we tend to see something that's a little bit more stable where it's going to hold its value and it's going to, upon maturity, you'll have an expected payout. Oftentimes, they'll have some performance indicator which may link to a specific index in the market, like the S&P, like the Dow, or something like that. And they may give you equity-like upside performance when the markets are up. And when the markets are down, they may give you some kind of stability, such as a bond where you hold it till maturity and you'll expect to get your principal back. Now, those are all relative terms and each one has to be looked on its own. But this is a very interesting time in the market and a very interesting product, which may have to some investors an advantage over the exchange traded funds, the regular ETFs. They may prefer to blend some of the exchange traded notes with the exchange traded funds, thereby gaining some efficiency and stability in the market without giving up as much of the traditional upside as you would tend to give when you were blending exchange traded funds with regular bonds, which typically will be underperforming the equities sector. So thank you for joining me today. It's been an honor. I look forward in creating more interesting and exciting content and more informative and educational content in the near future. So America, hang in there, think positive, and looking forward to catching you in the next one. Bye-bye.